Good morning and welcome everyone to our webinar on Scope's supranational rating methodology. I'm Alvise Lennkh-Yunus, head of Scope's sovereign and public sector team, and I'm delighted to be joined today by Carlo Capuano and Julian Zimmermann, who are responsible for our coverage of supranational entities and the lead authors of our supranational rating methodology. We would like to use today's webinar to explain the proposed changes of our criteria that we published earlier this month. To this end, I will start by giving you a very brief overview of the proposed changes, the rationale behind these, and their expected impact overall, and then hand over to Carlo and Julian for an in-depth discussion of the main change that we are proposing, which is the introduction of a risk-based capital metric for our capitalization assessment. At the end of our presentation, we will be happy to take any questions you may have, and we will also make sure you can download the slides at the end of the webinar. So what are the main changes and why are we proposing them? As you might know, we distinguish supranationals between those which are capitalized, mostly multilateral development banks, and those which are not capitalized. With our updated methodology, we maintain this distinction and introduce changes to both types of entities. However, let me say from the outset that most of the changes are applied to the capitalized institutions. So let's start with those, which is the box on the left-hand side. The most important update is the introduction of a risk-based capital metric to assess more granularly the capital adequacy of entities, accounting for MDB specificities. As I said, this is the main change, and Carlo and Julian will talk about this in greater detail later on. But we're also using this update to better distinguish governance factors that an institution can control on its own, so essentially its risk management practices, and those governance factors that are mostly exogenous, related to the statutes given by its shareholders. We are also adjusting the way we calculate high-quality liquid assets, essentially by expanding the universe of eligible assets to those instruments rated single A, which we then adjust with a haircut of 15%. Now, for capitalized institutions, overall, we are lowering the importance of shareholder ratings when determining the final ratings. And we're achieving this by ensuring that an institution that is assessed as having an excellent financial profile can be rated AAA, even in case it does not benefit from strong shareholder support. Finally, we're introducing group-wide considerations and adjusting the scorecards to lower cliff effects. Looking at non-capitalized institutions, the main changes are, first, we are lowering the weight of asset quality for those entities that have a high share of grant-based disbursements. And in such a situation, we propose to increase the importance of liquidity and funding. The changes I just mentioned regarding governance factors and liquid assets are identical to the ones I just mentioned for capitalized institutions. So we're also doing those for non-capitalized entities. But contrary to capitalized entities, we are increasing the weight of the importance of shareholders and reducing the importance of the intrinsic profile for the final rating of non-capitalized institutions. However, importantly, we maintain the possibility of an excellent financial profile, providing significant uplift of up to 4 notches for non-capitalized institutions. So why are we doing these changes, and what are we expecting, and why are we doing them now? Overall, we're introducing these changes in response to the evolving practices of the entities themselves, who are responding to the call from the G20 to optimize their capital adequacy frameworks and ultimately to do more, to lend more, to mobilize more capital with the same scarce resources. And we hope that our proposal is a constructive contribution to this evolving dialogue. What are the expected impacts? We have validated our proposals to our 8 publicly rated entities, as well as a list of 12 supranationals that we monitor via shadow estimates. So the sample that we are applying these changes to is comprehensive and representative in our view of the entire asset class. We do not expect an impact on final ratings from the proposed changes. However, we do expect a positive impact in terms of the potentially available headroom for entities to ultimately increase their activities without endangering their current high rating levels. Finally, just a brief word on the next steps. The call for comments is currently out and will end on April 10th. We look forward to receiving your comments and feedback until then, and it is our intention to incorporate your comments and adopt a final version of the methodology in the coming months and use this revised criteria for our forthcoming rating assessments later in the year. And with that, I'm happy to hand over to Carlo.
Thank you very much, Alvise, and good morning to everybody. Let's dive into the main change that we are proposing with this new methodology, which is the shift from the leverage ratio to the risk-based capitalization metric, as Alvise already mentioned, which is basically capital over credit risk-weighted assets. I think it's important to start with initial consideration. This shift is consistent with the reform agenda endorsed at G20 level, which underscores some limitations for the leverage ratio. In particular, it's not super sensitive in terms of the evolution of credit risk, and because it treats assets uniformly, and at the same time is an indicator probably more appropriate in terms of limiting the balance sheet expansion. By contrast, the risk capital measures allows us to assess the capacity to absorb unexpected losses, taking into account the business mix, the borrower quality, the preferred creditor status, and also credit enhancement, which of course cannot be captured by the simple leverage. Therefore, we see added value in this shift. As I said, the leverage ratio basically treats assets uniformly, whilst the risk-based capitalization metric based on RWAs incorporates sector-specific default considerations, recovery rates, assumptions, and also evolving credit enhancement practices. In turn, we decided to remove the qualitative portfolio quality assessment, as these analytical considerations are now part of the risk-based capitalization assessment. However, we didn't forget, the importance of the leverage assessment, which is now a complement indicator and helps us to account for the size of an institution's on and off balance sheet activities versus its capital. And again, this is consistent also with the G20 recommendation. Let's move on to understand what we include in this ratio, and we can start with the capital. Of course, the capital includes the paid-in capital, which comprises the contributions actually paid by shareholders. We have accumulated reserves, retained profits, also the total equity content of hybrid securities. But we also consider the so-called eligible capital call, which basically is based on our assessment, particular on highly rated shareholders. So those shareholders with a rating at least of AA- or above. In that case, we consider 10% of the callable capital, whilst again for these shareholders, if these callable capital, these funds have been authorized and appropriated, we consider 25% of this callable capital because this does not need the parliamentary approval, and these funds can be immediately disbursed. Regarding the mandate-related assets, we have, of course, disbursed loans, signed but undrawn loans with a 40% credit conversion factors, guarantees provided, and equity investments. These exposures are net of specific provisions and adjusted for credit enhancement, if applicable. For example, we apply credit substitutions and the appropriate risk weights of the guarantor when we have sufficient strong guarantees, and at the same time we apply reduction in exposure amounts to account also for eligible financial collateral, even though this is also subject to haircuts. Regarding assets, treasury assets, we include cash and cash equivalents, deposits, repo style transactions, and also debt securities. Let's now try to shed some lights on how we calibrated risk weights. For I want to start to say that we maintain a very conservative approach. In particular, for treasury assets, we decided to use the Basel standardized approach risk weights, while for mandate related assets, we try to balance. We try to strike the balance between Basel and also the implied risk weights from the GEM database. The GEM database, you may know, is the Global Emerging Markets database, which includes data on recovery rates and probability of default stemming from a representative sample of MDPs. Of course, these implied risk weights are lower than those from Basel, reflecting the strong track record of MDPs, including the PCS. But we saw value in this kind of exercise to balance these two approaches. In our calibration, we, as you can see from the table, this figure 3A of our methodology, we explicitly differentiate by rating category, type of exposures, in order to better reflect the granularity of the entity portfolios. And as you can see, we apply significantly lower risk weights to sovereign and sovereign guaranteed exposures with or without PCS. These are the first two lines compared to Basel, but also for public sector exposures, as well as to financial institutions rated in certain categories. But what I want to say is that in any case, we maintained a conservative approach compared to the GEM, and again, as I said, this is also reflected by the decision that for treasury assets, we use the risk weights from Basel. A couple of words on how we estimate the borrower quality. For treasury assets, typically we rely on credit risk information provided by issuers. If exposures can't be mapped to an appropriate risk category, we consider the exposure to be in the CCC category or lower. Regarding instead the related exposure, the mandate related exposures, here we start from a sovereign anchor. What does it mean? We calculate the weighted average rating of the 10 largest sovereign exposure. And then from this level of rating, we notch down conservatively for the other, the other type of borrowers, public sector, financial institutions, and also non-financial corporations. And then for non-financial corporations, we also may adjust, the estimate of the average borrower quality up to 2 notches, depending on the share of the portfolio that is mitigated by, the high climate risk. Last words on the concentration, how we treat the concentration here in this approach. Since the risk-based weighted, the risk weights approach considers portfolio highly diversified, we thought it's important also to take into consideration, the concentration. And for institutions that predominantly, have sovereign and sovereign guaranteed mandate related exposures, more than 75, equal or more than 75%, we assess single name concentration risks. If the top 10 exposures constitute more than 75% of total exposures, we apply a 50% increase in total mandate related RWAs. For other institutions, instead, we look at the sectoral and geographic concentration via the Erfindal and Hirschman index. If this index is above 2000, we apply an increase in the risk-weighted assets by 25%. But overall, we keep a cap. So the overall increase in the mandate-related RWAs can't be more than 50%. And with that, I will hand over to Julian, who will provide a case study.
With great pleasure. Good morning to everyone, and thank you for joining us this morning. So indeed, I wanted to share a case study with you based on stylized figures, and hopefully this should provide some better insights into the core principles and elements that Carlo just outlined on the risk-based capitalization metric. So before we go into the actual numbers, if we can move to the next slide, please. We wanted to share all the elements again and recap what is actually needed to perform this analysis. So for the numerator of the ratio, which is capital, we essentially need the paid-in portion of the equity. So this is the one that you will find on the balance sheet, being paid in capital reserves and retained net earnings. And then we look at also what we liken to non-core equity, which is also limited to 30% of total capital, which is the sum of eligible callable capital and the equity content of issued hybrids. For the denominator of the ratio, as Carlo explained, we look at risk-weighted assets being the main evolution of this proposed update. And this is comprised of mandate-related credit risk RWAs and treasury credit risk RWAs. We made the conscious decision to limit the analysis to credit risk, and we have observed essentially that this is the predominant source of risk that we observe for most MDBs. If we were to make the judgment that there's other material sources of risks that would be underestimated by this approach, we would tackle this with additional considerations. So let's get started with the case study. So again, these are stylized figures that we have randomly chosen, but these should be illustrative of typical analysis that we perform. So starting with capital, the numerator of the ratio, the proposed ratio, as said, we would look at the paid-in portion of equity and the retained earnings that entities typically generate over many years. And in this stylized example, this would represent the bulk of capital, being 13 billion, which you will see on the left-hand side of the slide. In addition to this, we will look at eligible callable capital. And in this stylized example, we have, you can see that this contributes a total of 1 billion euros to the total capital of this entity. And if you follow the gray arrow to the right-hand side, we wanted to split out a bit further how we arrive at the 1 billion you can see. In this example, callable capital is provided by 6 shareholders with the ratings you will see in the second column, and as split down accordingly over those 6 shareholders. As Carlo had explained earlier, we will look at whether any of these shareholders have already authorized and appropriated any of these funds in their national parliaments, which would typically allow us to assume that these funds would be provided on a more timely fashion and with a greater likelihood. And for that reason, we have decided some time ago that we want to appropriate a higher share to those funds. So we would increase the eligible share from 10% to 25%, and that you can see in the third column. So if we apply this analysis to the 12 billion of provided callable capital, you can see that this is in total 1 billion euros, which is provided by highly rated shareholders. And you will see that one shareholder, being shareholder 3 in this example, has also authorized and appropriated these funds previously. In this, so if we go back to the left-hand side of the slide, in this example, we have chosen that the institution has not issued any hybrid instruments. This is also representative of the fact that this asset class is a nascent one. There have been some public transactions, but for the time being, the hybrid asset class remains relatively limited in terms of size. So if we sum up these 3 positions for this entity, we would arrive at a total of 14 billion euros in capital. So moving on to risk-weighted assets, I just again wanted to recap very briefly what elements are needed to perform this analysis. We will again differentiate between mandate-related risk-weighted assets and treasury risk-weighted assets. Mandate-related being those that are a direct consequence of the mandate that is prescribed by shareholders. So as Carlo had alluded to, we look at loans. We look also at loans which are undrawn but signed. We look at guarantees, financial guarantees that are provided, and at equity investments. And then for treasury risk-weighted assets, we look essentially on the accounting values that the treasury investments are reported at. So let's dive into the actual example for risk-weighted assets. And please don't be alarmed by this slide. We are conscious of the fact that it's relatively full, but I will try my best to walk you through step by step and provide a clear example of what this analysis looks like in practice. So starting with mandate-related assets, for this chosen entity and example, you can see that the portfolio is comprised of loans, signed but undisbursed loans, guarantees, and equity investments. Again, trying our best to provide a representative example of the real world. In the second column, we have, of course, an indicator and an estimate of borrower quality. In this example, we have chosen to apply the so-called notching approach, which Carlo had explained. So essentially, we start with the sovereign rating as an anchor, which is the average rating that we derive from the top 10 exposures. And then we notch down conservatively for other types of exposures. In this case, this would be 2 notches for the public sector. So this would bring you into the BBB category. We notched down 3 notches for banks or financial institutions, which again would bring you into the BBB category. And then for non-financial corporates, we notched down conservatively by 6 notches. This analysis, we always will complement by information that is provided by the issuer on this portfolio to complement and sensibility check essentially this analysis that we perform. The third column is exposure, which is after credit enhancement and substitution, and also, as Carlo had said, after specific provisions. The risk weights we apply are the ones that you will find in figure 3A in the proposed methodology for mandate-related assets, and for treasury assets, as Carlo had said, these resemble Basel standardized risk weights, and we will find them in figure 3B. If we apply these risk weights to the exposure amounts that you see on this slide, we will arrive at the risk-weighted assets, again, on an illustrative basis. In this example, this would basically give us 22 billion in RWAs stemming from the loans. We would have 4 billion from loans signed but undisbursed. That's basically also driven by the credit conversion factor of 40%, so reducing the RWAs substantially. Guarantees, we implicitly have a 100% credit conversion factor. So basically applying the full risk weight to the exposure amount. And then for equity investments, we apply a blanket 250% risk weight to this imaginary position of 3 billion, giving you a 7.5 billion position here. So overall, we have roughly 40 billion euros in RWAs for this example. And if you, I think a nice and sort of telling indicator is also the average risk density, which is the 70% you see on the left, which is basically the dividing total exposure by risk-weighted assets to see the average risk density of this portfolio. Secondly, we will look at treasury assets. So in this example, we have a big position in cash and cash equivalents, which is 0 risk weighted. And then we also have a highly rated debt securities portfolio, which is basically sovereign and supranational issuers, rated single A, AA, and AAA. And most of those positions would also receive a 0 risk weight in our approach. You will see that the 200 million that come from the treasury assets is a very small portion of overall risk-weighted assets. This is actually representative of the validation exercise we have performed. And what we have typically seen is that institutions have very low risk treasury asset portfolios, and that usually the predominant source of risk weights stem from mandate-related assets. And I think that, again, is probably no surprise given how conservatively these institutions typically invest their assets. So overall, we have roughly 40 billion in credit risk RWAs. And if we go to the next slide, we will see the assessment that is performed then in a final step. So we will divide the 14 billion in capital with the roughly 40 billion in RWAs, arriving at a 35% ratio. And if you look at the table, you will see that this receives the highest score for this assessment, being the 35 and over. which we equate to a AAA equivalent ratio, so the strongest we see. And that basically concludes this case study. We hope that these figures shed some light on the typical analysis that an analyst would perform. And we are obviously also either pertaining to this element or others very open to your questions. So thank you for your attention.
Thank you, Julian and Carlo, for the presentation and the case study. In the meantime, we've actually received a couple of questions from the audience, which I'll try to group into general and technical questions. And in case we are unable to answer them today, we will certainly follow up in detail. We have questions ultimately about our competitors, so thank you for that, about the headroom, about PCS and portfolio quality and concentration risks. Let me start with a general one on our competitors. So the question: how is your methodology really different to the other CRAs? Fair question. It's a fair question because ultimately we're seeing that the methodologies are moving in a similar direction. We're seeing that all CRAs are introducing some form of a risk-based capital metric to assess capital adequacy. At the same time, we would argue that the granularity, the risk weights, the thresholds, the impact on final ratings is still quite different. We would argue that we are, in terms of granularity, not as granular at S&P. So S&P's RAC is still more granular than ours, but we're probably more granular than Fitch's approach, for example, since we're assessing risk weights by rating and the 7 types of asset classes that Carlo and Julian walked you through. Again, we also have the adjustment for concentration risks as part of the risk-weighted assets. So I think here you can see differences. You can also see differences in how we use and treat callable capital and how we treat and incorporate climate risks or potential climate risks for our assessment of the borrower quality. So yes, there is probably some convergence in these methodologies, including ours. But I still think that in the details, there are important differences. And again, as I said at the beginning, we hope that the proposal is a constructive contribution to this dialogue. So that's on our competitors. Then on the headroom, yes. Can you be more specific about the headroom that you expect? Thank you for the question. It's not straightforward to answer because let me state that the headroom, we obviously expect a significant positive impact on the headroom if we adopt this criteria in absolute and relative terms. In relative terms, relative to the current methodology that we have, and in absolute terms also because it very much reflects the low risk density of the large institutions. So the headroom that we have estimated roughly is around 1 trillion euros, which points to significant lending potential. But when we do such a calculation or such an estimate, we want to flag that there are important caveats to these numbers because it assumes critically that all other parameters remain unchanged. So that's a very big caveat. So when we say that it's about 1 trillion, we're assuming that other factors that impact our assessment, asset quality, liquidity and funding, shareholder support, that all of these are basically unchanged. And that's, as I said, that's an important assumption. The other thing to flag is that the headroom, the overall headroom for the asset class is driven by a very few institutions, which means that the number is more theoretical because in practice it will depend on the institution's own risk practices and their risk appetite, which in many ways is a political decision by the shareholders. So that also needs to be taken into account when we talk about headroom. The other thing to flag is because of their mandate, it's certainly advisable and certainly what these institutions do in any case to operate with a certain comfortable margin and buffer, simply because supranationals have to increase or are often called to increase activities exactly when there are times of economic and financial distress. So I hope that answers the question. We would make the case it's around 1 trillion euros, but 1 trillion euros, but there are important caveats. Moving to the more technical questions, so thank you for these. These are on PCS and portfolio quality, and as I said, concentration risks and equity. So let's start with PCS uplift. How do you incorporate the fact that supranationals benefit from PCS? Maybe Carlo or Julian, if you can take this one, please.
Yeah, I'll give it a first try, and Carlo, feel free to add, of course. So this we have essentially done via the calibration of our chosen risk weights for mandate-related assets. So as you can see, we have the first two lines in 3A, or if you might recall from Carlo's presentation, where we have chosen risk weights which are substantially lower than those you will find in the Basel standardized approach. And that's exactly what Carlo mentioned, is that we're trying to strike the right balance between an accepted and widely used standard, that is Basel III standardized risk weights, but also the fact that we have a 40-year track record stemming from the GEMS database, which is high quality, it's granular, and it's a very robust source for calibration. With the fact that we chose risk weights which are somewhat higher than those that we will find when you directly imply from the GEMS database, is that we are also conscious of the fact that there are some differences over time across regions and across individual institutions as well. So there is a degree of conservatism that we have chosen to apply to those risk weights. But we feel quite comfortable that, as you said, Alvise, that we can contribute to the ongoing dialogue and accept and acknowledge the fact that the track record of MDBs when it comes to their sovereign exposures is very strong. And we have, again, this is an attempt to strike the right balance with regards to this. We have also chosen to differentiate between sovereign borrowers that are currently in arrears or that have previously been in arrears with institutions, and those sovereigns that have always been current on their exposures. What we have done here is essentially that for those sovereigns that are current with an institution and have a strong track record of basically affording PCS, these exposures benefit from both low PDs and LGDs, so probability of default and loss given default rates. For those exposures that are actually currently in arrears, we have still chosen to choose relatively low risk weights, again, compared to Basel. And this reflects the fact that the LGD will still be favorable, even if there is an arrears status currently recorded. And that's, again, after specific provisions, as Carlo had mentioned. So again, this is our approach, and we have chosen to calibrate this directly into the chosen risk weights.
Thank you, Julian. We're getting several questions here, so let me try to group them. We're getting a question also on the portfolio quality, actually. Why did you decide to remove the assessment of portfolio quality for capitalized institutions? And then follow-up question is on the calibration of the concentration risks for how many sectors would you define for the purpose of calculating the sectoral Hirschman-Herfindahl index, simply because the granularity obviously will depend on the assessment. Is this done on country level granularity or different geography? And let's take these two, and then we have a couple of questions on equity also.
All right. No, I will take the one on why we decide to remove the portfolio quality, especially for capitalized institutions. As we said, we are introducing the risk-based capital metric, and we already incorporate in this assessment, the considerations regarding the borrower quality, sector-specific consideration in terms of default rates, assumptions on the recovery rates, and also, I would say, credit enhancement practices. So there is no need to have a separate, block where we assess the portfolio quality, because in that case we might risk double counting. But in any case, we continue to assess, for example, also the NPL ratios, And for non-capitalized institutions, of course, these entities can benefit from from capital that could absorb the economic the unexpected losses. So in that case, the portfolio quality assessment remains an important pillar in our assessment. I don't know, Julian, if you want also to comment on the other part of the question.
Yeah, happy to. And no, I think that's an important question. So thank you for posting it today. Essentially, there will be some degree of reliance on the disclosure we have, of course. So we will have an economic sector split, which will be the basis for calculating the concentration measure. We will try, or we will basically aim to harmonize this disclosure as much as possible. So we look at, for example, Eurostat NACE sectors that obviously give us the breakdown per economic sector. So the headline sector, there's obviously many more breakdowns. And on that basis, have a harmonized basis to calculate this. This will obviously not be performed for sovereign borrowers because they do not represent an economic sector as such. For the country level or the geographical concentration measure, we will look at the country level disclosure. So this is typically provided by issuers, and we have this information for the entire sample that we performed the validation on.
Thank you. I think we have a couple of questions on equity, especially how we treat equity exposures related to undispersed equity commitments. You talked, Julian, about the credit conversion factor that we use for undispersed loans. Can we share any insights how we go about this for equity exposures?
I'll try my best again. So essentially what we have is either on balance sheet, and that's just equity that's accounted at a certain valuation on the balance sheet. I think what the question might be alluding to is the undrawn portion of funds. So if you are a limited partner or a general partner in a fund or a fund of funds, which is also something that we observe for institutions, you obviously have a commitment to the fund, and that is drawn down by the manager of the fund over time. If we have observed that typically, historically, these funds are fully drawn by the managing entity of the fund, we would have a 100% credit conversion implicitly here. So assuming that this, again, will be drawn down eventually over the life cycle of the fund, we would capture this with basically looking at the full exposure for calculating RWA.
No, thank you, Julian. In the meantime, we've had follow-up questions. One is on treasury assets, actually. You're just to remind everyone, under the current methodology, we're defining liquid assets as those being rated AA- or above. The proposal is to lower this threshold to single A rated debt, and the question is whether we would consider extending this even further to the BBB range with higher haircuts. Do we have any thoughts on that? I mean,
yeah, I'll try again if you allow me. So in the calibration of this step, where we chose to also extend the definition to single A rated securities, we have essentially followed Basel so the LCR calculation regulation. So this is essentially the level 2A HQLA. So you will still have sovereign exposures that are rated in the single A category with the 15% haircut. And we have basically decided that this is an accepted benchmark that is applied to financial institutions and should therefore also be relevant for MDB and also obviously non-capitalized institutions where we look at liquidity as well. So this is again taking inspiration from Basel, which I think strikes a good balance between allowing a wider share of assets to be included in our calculations, but not going as far as the BBB range. And I think that, as you correctly say, is included in LCR calculations with higher haircuts. Typically, the portfolios we have observed for these institutions, being the 8 rated institutions and the 12 shadow credit estimates that we look at, there's very rarely is there treasury assets that are not rated single A or higher. So essentially this, given the conservative investment guidelines, typically there is either not such a segment or it's very, very small. Yeah.
I think that's ultimately why we've kept the range at the single A for overall. I think I'm also conscious of time, so we're at the end of our presentation for today. I would like to thank you all very much for the questions that you have posted that have really made this discussion more lively. In case we have not answered your question, we will make sure that we answer all of your questions individually, so you will certainly hear from us. And as I promised at the beginning, we will make available the presentation for download, and I hope you will be able to get the download button. There it is. So please feel free to download the presentation. We're happy to receive any additional comments that you might have, and look forward to hearing you from you by April 10th. And thank you very much for today's attention and discussion. Bye-bye. Thank you.